Alright guys, welcome back. So today we are going to go into some more advanced concepts now and start to piece everything together. And we are going to jump into what we call top-down analysis. So what is top-down analysis? Top-down analysis is looking at the market from a bird's eye view, as you would imply, top-down. And what that entails is looking at it from the higher time frames right through to the lower time frames. So how do we do this? What do we use it for? Let's go back to GU for an example. And I'm just going to pull up a new GU chart on Orlando. And I'm going to go to the weekly chart. Let's clear all this. I'm going to go to the 1 week, right? I'm going to show you how the market, does exactly what you want it to do and how you can, just follow along and get entries based upon every confirmation. So top-down analysis, why do we use it? Let me write this here for you. 1, to get directional bias. Find supply and demand zones. And 3, find liquidity. Right? This is what I use top-down for, right? You want to get your directional bias, you want to find supply and demand zones, and you want to find liquidity, right? Let me, spelled that wrong. There we go. So I'm on the weekly here. I can even go to the monthly if you really want to, see this. You can see like GU has been in a steady decline from 2007, started up here, and then, now we're down here somewhere, right? So overall, GU has been very bearish on the extremely high time frames. But now if I start making my way down and getting a deeper picture of the market, you can start to piece some things together. Now, I want to write this as well here. Your job in the markets is to read what the banks are doing, right? That's all. Just read the story, right? Read the narrative and get the story that is being told, right? Let them write it for you and just trade it. So now if we head down into the weekly, right? Remember, each candle is a week. Find liquidity, right? And find that directional bias. Equal lows. Remember the concept. Run of the lows, break of the high. So it is safe to say that the directional bias currently is in an uptrend, is in a bullish market condition, right? Because we have on the higher time frame a confirmation of the institutional concept of double bottom, run the liquidity, break of the high. Now, one thing to note here, higher time frame trumps lower time frame, meaning these higher time frames hold much more weight than the 1 minute, 5 minute, 1 hour. Once you understand that, you'll have much more safer entries. So, runs the low, breaks the high. Once you got that, right, if I just pull GU back to here, for example, if we take it back to like the end of 2020, and you analyze this market condition, boom, you saw this break. You also were monitoring this demand zone because we actually did get a reaction here. And then you see it break through. This is a concept we will jump into a bit later on called an S&D flip. But you saw it break through. And on your structure, if I put the line chart on, low, low, run, break. Well, now you can see we are heading upwards. So why do I use the higher time frame analysis? It allows me to get my directional bias, and now I can do this. I can start to scale in. Now I'm jumping down to the daily. I'm trying to read the story that the market's giving me, right? You can see back in here, you had a low, you had a break, right? Then what has happened? The market has come and mitigated this off, right? Get rid of this. Cool. Then it has continued pushing up higher, breaking structure. And it has taken out that high that caused the low, giving me confirmation this is going to go higher. The market then steadily, continues its uptrend into the desired direction, right? So once it has, all these confirmations that market's going to go up, you knew that you should only be looking for buy scenarios in these markets to hold long term if you're swinging, right? This is where now you can start diving down deeper, right? Reading the story that the banks are trying to tell you, right? Watch. Once it hit that daily candle, what happened? Had a low, lower high, till we broke up. Cool. What happens? Find the candle that has forced this push up. You had a couple right here, as well as right here. And then what happens? Market continues, right? Market continues going up. We talked about trend liquidity. We also talked about the double top formation. The market was telling you the story, guys. It needed to run these out, right? So it comes and mitigates this. If I pull back, I will show you exactly what the market did. Remember, all you're trying to do is tick off the boxes. You want everything to be bullish here, right? Breaks the high, boom. Comes down, mitigates this. I'm going to jump down now back into the 1 hour. That was 4 hour time frame, right? Look how clean that 1 hour candle is. You see now how I can refine this entry down to here, giving me a much smaller stop loss, right? 1 hour, it runs it. I'm going to use this line as my low. Cool. Let's get rid of these so I don't confuse you. Now I'm going to go down to the 30-minute. Cool. What's in here? Well, we have this really big down candle here. Let's make this a nice bright blue, cyan. And then the market pumps up above the high that got you there, as well as this high. Market then trades back down into the down before the up and does what? Hangs around in there until you get the break of structure. Once again, breaking the high that got you into here, and then market comes back into the down candle before continuing up. Now I can keep refining this entry as much as I want, right? Because all I was doing here was, focusing on the narrative. And obviously the data point is not able to be found because it is so far back, right? But you guys get the picture that the higher time frame analysis was going to allow you to get entries here based upon everything that has been occurring into the market, right? So you know that your directional bias is to the upside, right? Even up here, look at the order flow as we spoke about and the structure that was occurring, right? You can pull back into any given time, go down to the time frames, you know the directional bias is up, and have a look at what's happening, right? Market's been trending up, up, up. You're waiting for that concept to occur. And did you guys see it right there? Your low, break the high. Here's the high and low now, your trading range, right? Whoops. If I pair what we learned in the last video, I'm going to draw that Fibonacci from top to bottom. There's that 80% mark. What's in there? There's that last big down candle on the 4 hour. Let's scale down. I'm going to jump into my 2 hour here. Same thing. 1 hour here. Same thing. Down candles in there. Right, I'm going to see if I can get down a bit further to show you guys what happened. And as you can see, it holds this structure and continues. Now, yes, you can see here we have these other areas that price has been reacting from. But the directional bias is so important. That's why we do higher time frame. And then the market continues and breaks through these areas, right? So once you can understand why we use those higher time frame analysis, well, you can then get, all your entries into these markets. And if you just saw what happened there, right, it actually looked really clean on the 30-minute. When we were getting up into this area, we caused a take of the low in there. I draw my little arrow, little low there. Let me just remove this. There's a low. Here's this low that runs it and breaks higher. You also had trend liquidity there, would have been like a 5-minute time frame. And then, you broke higher, and the market has this candle that price trades back into. Yes, it just nicks it just above it and then continues going higher. Because, the directional bias here is bullish. So these are how you get these really nice entries that you're swinging for hundreds of pips, because the higher time frame is always on your side. So the trick here is when HTF meets LTF, your trade is A1 and safe. When higher time frame meets lower time frame, it's A1. It should actually be, when LTF meets HTF, your trade is A1. So when your lower time frame entry meets the higher time frame, your trade is good. So hopefully that makes sense, guys. And this should allow you to understand a little bit better directional bias in the market, understanding when markets are probably going to turn and continue coming downward, and when they're going to continue going up.